There's a new 3 ETF portfolio that's been quietly crushing the traditional ones. It's simpler, safer, and honestly, way more suited for 2025's market than the old school setups we've all seen 100 times. I've tested dozens of ETF combos over the past few years, from classic 60/40s to all dividend setups. And this one just kept outperforming, not by a tiny bit either, by a margin that actually made me rethink my own portfolio. So in this video, I'm going to break it all down for you. The 3 ETFs, the exact allocations based on your age, and why this portfolio beats almost everything else out there right now. And I'll walk you through how to actually build it, step by step, without overcomplicating things. By the end of this video, you'll have a complete, simple investing plan that just works. Here's a quick disclaimer. This video is for educational and entertainment purposes only. I'm not a financial advisor, and nothing here should be taken as financial advice. Always do your own research or talk to a licensed professional before making any investing decisions. Before we get into the new stuff, let's rewind a bit. If you've been around investing for a while, you've probably heard of Jack Bogle, the founder of Vanguard and the guy who basically started the whole index fund revolution. He wrote The Little Book of Common Sense Investing, and his big message was simple. Don't try to beat the market, just own the market. And that's where the original 3-fund portfolio came from. It had US stocks, international stocks, and bonds. That's it. Simple, diversified, and incredibly effective at the time. But here's the thing. That was decades ago. Back then, bonds actually gave you solid returns and real protection when stocks fell. Today, not so much. Inflation eats away at them, yields are low, and markets are way more global and tech-driven than they used to be. Then there's international ETFs. For years, people thought spreading money outside the US would protect them and give extra growth. But if you look at the numbers, many international funds have consistently underperformed US stocks over the past decade. While they are important for a US-specific downturn, Europe, Japan, and emerging markets just haven't kept pace with the US tech boom. And with globalization, you're basically paying for exposure you could already get indirectly. Companies like Apple, Microsoft, Starbucks, and Amazon aren't just US-focused anymore. They make money all over the world. So when you invest in US stocks, you're already getting global exposure without having to buy an international fund. It's like getting a 2-for-1 deal without the extra effort. So what used to be smart diversification, the old 3-fund mix, now just adds dead weight. You've got assets that don't grow as much as they should and don't protect like they used to. That's why we need a new type of diversification, one that actually grows your portfolio while still offering protection. And that's exactly what the upgraded 3 ETF portfolio is designed to do. So, while Bogle's idea was genius for its time, it's due for an upgrade. So, let's upgrade this classic for the modern world. Now that we've covered why the old setup doesn't really work anymore, let's dive into the new 3 ETF portfolio, a modern, simple, and powerful way to invest in 2025. We're keeping the spirit of Bogle's simplicity, but we're upgrading the pieces that have become outdated. First, the foundation. This is your core market exposure. You can stick with VTI, VOO, or even SPLG. All of these basically cover the entire US stock market. Think of this as the base of your portfolio. Companies like Apple, Microsoft, Johnson & Johnson. The big, reliable names that have been around for decades. This part grows steadily over time, and owning it means you're essentially owning the US economy. It's boring, yes, but boring is good when it comes to long-term investing. And second, the stability piece. This is where we ditch traditional bonds like BND and replace them with SCHD. Now, why SCHD? Because it does something bonds can't do anymore. It gives you both income and stability. It invests in high-quality, cash flow positive companies like Pepsi, Coca-Cola, and Texas Instruments. It pays a dividend yield of about 3.5%, and it has a beta of around 0.77, which means it moves less than the overall market, giving you that safety cushion without stagnating like bonds. Compare it to BND or other bond funds. Bonds might average 2 to 3% a year, and that's before inflation. SCHD, on the other hand, has historically delivered closer to 10% annual total returns, while still being relatively stable. That's a huge upgrade for the same role in your portfolio. Third, the growth engine. Instead of international ETFs like VIXs, which have struggled to hit even 5% returns in recent years, we use something like SCHG, QQQM, or VUG. These ETFs focus on large-cap growth and tech-driven innovation, capturing companies that are shaping the future: NVIDIA, Amazon, Meta, Google, basically the giants of AI, cloud computing, and software. Yes, they're more volatile than bonds or dividend stocks, but paired with SCHD and VTI, they add significant upside without unbalancing your portfolio. So here's the simple formula: foundation plus dividends plus growth. Your VTI or S&P 500 ETF gives you steady, broad exposure. SCHD adds stability and income. And your growth ETF captures high potential returns. That's it. 3 ETFs, balanced, simple, and designed to perform in today's market. No complicated sector rotations, no chasing trends, no overthinking. Just 3 funds working together to grow and protect your portfolio. It's simple, it's effective, and it's exactly what a modern, long-term investor needs. Now that we know which 3 ETFs to use, let's talk about how to allocate them based on your age. This is where the magic happens. The same 3 ETFs can work differently depending on how many years you have until retirement. Young investors, 20s to 30s. If you're in your 20s or 30s, you've got plenty of time to ride the ups and downs of the market. Your goal here is growth, but still with some balance. A good starting point is 30% SCHD, 30% VTI, 30% growth, and 10% fund money. That last 10% is where you can experiment a bit. Maybe a small sector ETF, a promising AI stock, or something that excites you. This keeps investing fun while your main portfolio steadily grows. Also, keep a small emergency fund accessible. The best way? Roth IRA contributions. You can withdraw the contributions anytime, tax-free, if you really need them. Meanwhile, the rest of your investments are still compounding. That's like having your cake and eating it too. 20 years out, early 40s. By your 40s, you've got runway, but you also need to start thinking about stability. Here, a smart mix is 30% SCHD, 35% VTI, 35% growth. You're still leaning into growth because one more bull run could make a big difference. But your portfolio starts to balance a bit more to protect what you've built. Keep about 6 months of emergency expenses ready, either in a Roth IRA or a high-yield savings account, so life's unexpected events don't derail your plan. 10 years out, 50s. By your 50s, you're still growth-oriented, but the focus starts to shift slightly toward preservation. A good allocation here is 40% SCHD, 30% VTI, 30% growth. You've still got one more potential bull market ahead, but the larger dividend allocation starts to stabilize your returns. Again, keep at least 1 year of expenses accessible. 5 years from retirement. If you're about 5 years out, the goal is to protect what you've built while still getting some growth. A good allocation here is 40% SCHD, 40% VTI, and 20% growth. You're tilting more towards stability with dividends, but keeping a slice in growth ensures you don't miss out on market gains. And don't forget the 1-year emergency expenses. Retirement or financially independent. Once you're retired or financially independent, your portfolio is mostly about income and safety, not chasing growth. Here, try 50% SCHD, 40% VTI, and 10% growth. SCHD becomes the backbone. Steady dividends that pay you each month, while VTI continues to provide market exposure. The 10% growth slice keeps a little upside without risking too much. A quick tip, even at this stage, you can optionally add 10 to 20% in bonds if you want extra comfort. It's not necessary, but some people sleep better knowing there's a little extra stability. The key takeaway, the formula for the portfolio doesn't change. Only the percentages shift as you age. The closer you get to retirement, the more you should emphasize dividends and stability, and consider reducing your exposure to growth stocks. All right, now let's talk about something that's just as important, maybe even more important than which ETFs you pick: your mindset and overall strategy. Because here's the truth, you can have the perfect portfolio, but if you're constantly panicking, chasing the latest trend, or reacting to every market headline, it won't matter. Most people fail at investing, not because they chose the wrong fund, but because they couldn't stay consistent. So, the first rule is keep it simple. Set up automatic contributions. weekly, bi-weekly, monthly, whatever fits your cash flow. Let it run in the background. The less you tinker, the better the results. Second, remember one bad year isn't a failure. Take 2022, for example. Stocks, bonds, almost everything dropped. But investors who stayed the course, continued contributing, and didn't panic. They were already ahead in 2023. Look at the long-term trend, not short-term noise. Investing is about decades, not days. And finally, instead of checking your portfolio every morning or panicking over red candles, just revisit your allocations once a year. That's it. Adjust if needed, rebalance, and then move on with your life. Think of it like setting your GPS and letting it guide you. You don't need to check every intersection along the way. If you follow these simple principles, automate, stay patient, and check in yearly, your portfolio will do the heavy lifting while you focus on living your life. That's the real secret to stress-free long-term investing. So, to wrap it all up, one core ETF, one dividend ETF, and one growth ETF. That's it. Simple, modern, and a powerful upgrade to Bougle's classic 3-fund portfolio. Test this kind of setup yourself, track it for a few months, and you'll start to see how it balances growth and stability without overcomplicating things. Just adjust the allocations according to the stage of your life.